Let's talk about what the Santa Clara County single-family home market is doing right now and what that means for both buyers and sellers. If you're looking for data on condos, townhomes, or nearby counties, reach out and I can get those for you. For simplicity purposes, today we're going to focus on just single-family homes. As of April 3rd, there were 1,244 active single-family listings, 671 homes pending, and the absorption rate was about 53.9%, which puts us in a pretty balanced market. The absorption rate matters because it gives us a clean read on supply versus demand. And a balanced market is important because it usually means opportunity exists on both sides, but only when expectations and strategy are realistic. That's still a very different setup from what both buyers and sellers were dealing with just 2 years ago. If you go back to early April of 2024, there were 798 active listings and 715 pendings, which created almost a 90% absorption rate. That was much more intense, seller-favored environment where buyers had fewer choices and much less time to think. In early April last year, inventory had increased to 1,211, pendings were at 712, and absorption rate eased to about 60%. Now in early April of this year, inventory sits at 1,244 and pendings are at 671, and an absorption rate is about 54%. So year over year, inventory is up 2.7%, pending activity is down 5.8%, and the market is still giving buyers more choices with less frenzy than it did the prior spring markets. At the same time, 671 pendings is still a meaningful number, so sellers should not mistake balanced for dead. The short-term trend tells an important story too. Over the last 4 weeks, active inventory moved from 1,109 on March 13th to 1,267 on March 27th before easing slightly to 1,244 on April 3rd. Pending sales were 680 on March 13th, 678 on the 27th, and 671 on the 3rd. The market actually started off pretty strong this spring. Inventory was building, buyers were still engaging, and pending activity held in a relatively tight range, even as more homes came on the market. But then we had a new layer of hesitation enter the picture. The Iran conflict brought daily market volatility, rising oil price concerns, and a visible hit to consumer sentiment, especially among middle and higher income households where it matters a lot in a place like Silicon Valley. That kind of day-to-day uncertainty tends to make both buyers and sellers pause a bit, not necessarily because their long-term plans changed, but because financial decisions feel a little bit harder when headlines and stock market are bouncing around day to day. And on top of that, we also hit a calendar stretch that often slows people down anyway. Easter holiday and the beginning of April, and the tax deadline on the 15th right behind it. Both those two things can create a short-term pause in housing decisions and activity sometimes. People travel, spend time with family, meet with accountants, review their taxes, and mentally put those major housing decisions on hold for a week or so. So if activity feels a little softer this immediate window, that doesn't automatically mean the market is fundamentally breaking down. Some of this is simply seasonal and situational timing. For buyers, that means this might be a window where there's a little more room to breathe. Ask questions, negotiate thoughtfully, especially if other buyers are hesitating because of volatility or distractions, but it does not mean the best homes will stop attracting attention. They still will. For sellers, it means this is not the time to panic if traffic or urgency feels a little slower over the holiday and tax stretch. There's still real demand in the market, but buyers might be taking a beat before making decisions. And that means presentation, pricing, and patience matter. Now, some buyers hear all of this and immediately ask, should I just wait? Maybe they're thinking of affordability rates or whether 2027 will be better. But here's the reality. Affordability has always been an issue here, especially in Silicon Valley, so that part is not new. And if you're waiting on the Fed to bail you out with rates, the current outlook still points to just one rate cut this year and one next year, not some dramatic drop that suddenly changes the whole game. Rates are only a part of the story in our valley. You also have to watch the stock market, especially tech stocks, because buyer confidence here is tied closely to stock compensation, vested shares, and overall tech wealth. When the tech market feels strong, buyers tend to feel stronger, and when it feels a little shaky, buyers pause, even if housing supply itself has not changed much. That affects sellers too. In Silicon Valley, the seller is not just competing against rates. They're competing against buyer confidence, stock market psychology, and how liquid or cautious local tech buyers feel at that moment. And how about new construction? With limited space available, as always here, it has clearly not solved the housing shortage here. And long-term supply constraints are still part of why Silicon Valley stays expensive. There is additional commentary that inventory could begin to open up as pandemic-era low-rate loans and ARM periods age out closer to 2027, but that's still more of a developing opportunity than a guarantee. So if buyers are waiting for a huge flood of inventory or sellers are fearing one, the data does not really support it at this juncture anyway. For active buyers, I think it creates two practical options if you're not finding the home you want right now. Number one, step up and buy at a higher price because the neighborhood you really want is not likely to come down just for you. Number two, expand your search radius and stay realistic about what your money actually buys today. For sellers, the takeaway is different, but just as important. If you have a good home in a desirable area, this can still be a very good opportunity to sell, but only if you respect today's buyer psychology and price the property in line with the current market instead of yesterday's headlines. So bottom line, this is a better market for educated buyers than the market we saw in 2024 because there's more inventory, less pressure, and more room for strategy. And for sellers, it's still a good market, but one where strategy, pricing, and condition and marketing matter more than they did when absorption rate was close to 90%. So whether you're buying or selling, don't make your decision based on hope, fear, or God forbid, the headlines. Make it based on your timing, your goals, and what the data is actually telling you. If you're thinking about buying or selling, or you just want sanity, check your plan against what's really happening in today's market. Reach out and let's talk strategy. I'm here to walk you through the numbers, the timing, and the options that make sense for you and your family right now, not just the headlines. As always, I'm Shannon Ellison here to educate and navigate, not speculate and fabricate, and I'll see you in my next video.